Bryn Jones, who was sat in that seat in the first hour, said the Germans want their cake and eat it.
Yes.
And this is bogus when they are enjoying and reaping the benefits as an exporting nation, as a surplus economy of this very weak euro that's been the result of all this monetary activism.
Yeah.
Is that a fair criticism of the Germans?
Well, some Germans have benefited hugely. Others would say that interest rates across Europe as a whole are way too low as a consequence of what the ECB is doing. And that means that a lot of German savers are having to basically pay the bill for problems that are in other parts of Europe. But I think it's really important to stress this, that over the course of the Eurozone crisis itself, it started partly because German savers were lending their money to people in Southern Europe. It wasn't so much that Southern Europeans were borrowing too much, it was really that Germans were lending too much. They were driving interest rates in Southern Europe down to lower and lower levels, effectively encouraging Southern Europeans to borrow more and more. And when things go wrong, the view from Germany is it's entirely the fault of the Southern Europeans, nothing to do with us at all, therefore they're the ones who should suffer, and we'll just walk away as if nothing really has happened. And this is like a sort of Victorian morality tale that a creditor is always a good person, a debtor is always a bad person, but in truth they're just two sides of the same coin, and that I think has not been properly recognised in Germany. So the way you properly do it in these circumstances is that if you had a kind of economic crisis, the kind that we saw, in a political sense, you'd have a kind of burden-sharing arrangement, which is where you come back to the whole issue of some kind of fiscal union. But Europe doesn't have a burden-sharing arrangement, so when things go wrong, it's the debtors who pay the price and the creditors walk away, and that's exactly what's happened with Germany vis-à-vis Southern Europe.
Is there an accuracy from the market valuation on the price-to-book valuation of the German banks and European banks in general that says there is still a massive problem about the value of those loans, about the value of those assets, about the book being held by German? Because you look on a price-to-book, and it's not just a German problem; it's a pan-European problem as well. But the market is saying there is an enormous problem on the difference between the asset value, or perhaps even the capital that still needs to be raised, perhaps as a legacy of what you just said.
Yeah. Well, the word that springs to mind is actually Japan, funnily enough, because in Japan's case in the 1990s and beyond, the banks had problems partly because the actual performance of the Japanese economy was far weaker than anyone had expected. The nominal growth rate, the combination of growth and inflation, much, much lower than was expected for year after year after year. So that basically meant that good loans turned bad. You think of a good loan as a loan that can be repaid in the future based on some assumption about what's going to happen to future income growth. If it turns out that assumption is incorrect, that income growth is actually a lot lower than you thought, then some of those good loans will turn bad. Now, the same problem exists in parts of Europe, that the performance of the overall Eurozone economy has been a lot weaker than people had expected a few years back. You look at the undershoots on nominal GDP compared with the forecast made at around about the time of the financial crisis. France is about 18% lower than it should have been on the basis of nominal performance. Italy is about 23% lower than it should have been. Spain 30% lower than it should have been. So these are huge shortfalls. So all these loans that were made during the good times now don't look quite so good, and therefore you end up with a weaker banking system than you would like.